We're going to discuss business income in this afternoon's presentation. Before digging in, I'd like to make a few overall comments concerning the subject. So consider this your fair warning. First, we'll start out with a discussion of what a business is and how to best determine whether a taxpayer or a couple who jointly own a business really have a business. So this is one area where you'll probably encounter the biggest issues in terms of, quote, shady stuff that taxpayers may try to do. I'm not trying to demean general taxpayers or human beings in general, but in my short time as a tax counselor, this is where for some people, human nature shines through, although shines is probably not the right word to use. The reporting of business income is not a game, but think of it as one. The goal is to offset business income with expenses, and any and all that are legitimate. The less money left over, which is potentially taxable profit, the better for it from a tax perspective for the taxpayer. We're really talking about single-person businesses here, not Amazon. The taxpayer should legitimately want to claim every expense they can, and we should absolutely help them do so. But pay close attention to anything they may say about things like cash income they may have, lack of any expense records, or saying they didn't have any expenses. I mean, how many true businesses don't have any expenses? Maybe a handful we'll talk about later, but not very many. Okay, you've been warned. Let's get started. This document contains a summary of important self-employment tax issues, including self-employment examples, and can be a helpful resource. I'd recommend having a copy available in your Chromebook or knowing where to find it when needed. And before I forget, I'm going to use the terms business and self-employment as we move through the discussion. Keep in mind the businesses we're discussing are really just single-person businesses, and as such, income these businesses receive will be referred to as self-employment income, which is treated differently than normal wages in a W-2. On the intake interview and quality review sheet, taxpayers may indicate they received self-employment income or unsure if they did, which may indicate they received cash for some type of service performed or goods sold. They may not think of themselves as self-employed if they have a small home business or work part-time as an independent contractor, which may lead them to believe cash income is not taxable. They should have records available of cash income received and expenses they may have paid, and if not, they should be able to reasonably reconstruct documentation of income they received by looking at deposit information from cash and credit cards, expense records by checking any cash register tapes they may have saved, invoices they may have received, and check-in orders they may have placed with online retailers like Amazon. Try to ensure the taxpayers understand before starting their tax return that they should be prepared to provide receipts and other documentation for claimed income and expenses in the event of an IRS audit. Let them know that they are responsible for everything on the return. Here is a self-employed worksheet. Asking potential self-employed taxpayers to fill out this worksheet would go a long way towards determining pretty quickly if their returns are in scope or not, and at the same time could help ensure that the taxpayers identify income and expenses they may have overlooked. It could save taxpayers and you valuable time. So, 3 steps to determine business income. First, determine if the activity is a business. Then, determine sources of income. And finally, determine expenses. Are they allowable and are they in scope? Taxpayers may try to make up a business with no expenses just to try and get the earned income credit. Try to determine if what they call a business is being conducted in a business-like manner. Business-like records being maintained, like ledger, spreadsheet, maybe using Quicken product, receipts of expenses, copies of invoices, receipts given to customers would lead towards a taxpayer having a legitimate business. Are they claiming all expenses or any at all? Watch for examples of incorrect, incomplete, or inconsistent information, like Schedule C income in round numbers, $100, $500, and so forth. Schedule C cash business is the only income on a return claiming the earned income credit. No W-2s. Schedule C with little or no expenses when expenses would have been expected. Again, what business doesn't have expenses? And any Schedule C income that brings the taxpayer to the maximum EIC credit level. We need to determine whether the taxpayer is really running a business or something else, which should be determined during the interview process. The expectation is that businesses are set up to make a profit, unlike nonprofit organizations' purpose, which is to provide a service or a benefit to the community with no intention of making a profit. Like us, if someone continues to operate a business that loses money, it may be more of a hobby than a business, which is intended to provide a means of livelihood, meaning provide the owner with the necessities of life, including food, housing, and so forth. Regular activity might be once a year, sporadic time of the year, like a self-employed tax preparer who only works during tax season, or a shopping mall Santa, if there are any of them, still around, and conducted in a business-like manner. That include having a system or logs like Quicken or spreadsheets to track expenses and income, including a log of vehicle mileage if a vehicle is necessary in the business. The taxpayers don't need some type of formal reporting software, although something like Quicken wouldn't hurt, but a simple log with miles driven per calendar day would be sufficient for reporting things like mileage expense. So an activity that the taxpayer may perform that's not entered into for profit is out of scope for us because it's probably a hobby. Antique hunting, as an example, when not in the business. Stamp or coin collecting. Usually a hobby is more pleasure-driven than income-driven. There are a number of criteria that can be used to look at, is it a business or a hobby? Like the manner that a taxpayer carries on that activity, the expertise of the taxpayer involved in the activity, time and effort they allocate to it. Has the taxpayer had success with similar or dissimilar activities in the past? What's the history of income and loss for the activity? Are there occasional profits? And if so, how much? What's the financial status of the taxpayer? Meaning, does the taxpayer rely on this business activity, or does the taxpayer have other sources of income? And again, are there elements of personal pleasure or recreation? If I take my friends fishing every weekend and they pay me $30 cash because I drive them there, is that a business or a hobby? So there are income producing or income generating activities that a taxpayer may perform that is not a business and really would consider to be some type of other income. Now, income from activities like selling dishes, golf clubs, tools on eBay, Craigslist, those, if they're your personal items, if they were the taxpayer's personal items, then that's not a business, and it's not even really other income that gets reported. There is a category of other income, and those are things like prizes and awards that somebody might receive, jury duty pay. One of them is income from rental of personal rental property. If the taxpayer didn't rent for profit and they're not in the business of renting property. Again, we can only go up to 14 days maximum and not be out of scope. So there is an other income category in tax layer. It can be recorded, and it is for those one-time things like prizes and awards. Scope. In a nutshell, taxpayers must have expenses of $35,000 or less, use the cash method of accounting, have no inventory or employees, not have a net loss, not deduct expenses for business use of a home or depreciation of expense items. More than one Schedule C can be prepared if the taxpayers have more than one business. If taxpayers have a Schedule C that falls outside these parameters, refer them to a professional tax preparer. Now, cash method as opposed to accrual. The main difference between accrual and cash basis accounting lies in the timing of when the revenue and expenses are recognized. The cash method provides an immediate recognition of revenue and expenses, while the accrual method focuses on anticipated revenue and expenses. All our taxpayers normally satisfy the cash method requirement, otherwise out of scope. Again, returns with a business loss have always been out of scope. If a new taxpayer comes with a loss carryover, refer them to a professional preparer. Depreciation. The cost of items that are expected to last more than a year are spread over a period of years rather than deducted in the year of purchase. If the taxpayers have such a cost from a prior year's purchase, they should be referred to a professional taxpayer. Again, out of scope. And bartering. Exchanging goods or service for other goods or services, that's out of scope for us as well. No need to memorize everything I'm going to say about this slide, but I did want to point out the differences between and what are sole proprietors, independent contractors, and statutory employees. A sole proprietor is someone who owns an unincorporated business by himself or herself. A sole proprietor is self-employed because they operate their own business. A sole proprietor may do contract work and also earn income through the sale of goods or services. An independent contractor is someone who does a specific work for a company for a set fee. So the difference between the two is how they earn income. Independent contractors, specific tasks for clients for set fee. Sole proprietors may do contract work, but they also have other revenue streams, like selling their own products to customers. They're similar in that both separate their business expenses from personal expenses, pay self-employment taxes on business revenue, file income taxes with the Schedule C form, and work for themselves rather than an employer. Now, a statutory employee is treated as an employee with regard to Social Security and Medicare taxes and receives a W-2 from the employer, but is viewed as an independent contractor from an income tax perspective. So basically, as a statutory employee, a taxpayer's tax status is a blend of a traditional employee and a business owner. Like other employees issued a W-2, the employer is responsible for withholding Social Security and Medicare taxes. Like a business, the taxpayer will report earnings on Schedule C and will be able to deduct certain business-related expenses. If the taxpayer receives a Form W-2 and the statutory employee box in box 13 of that form is checked, report the income and expenses related to that income on Schedule C. Enter statutory employee income from box 1 of Form W-2 on the line 1 of Schedule C and check the box on that line. If running two businesses that are taxed as sole proprietorships, the Internal Revenue Service requires reporting the income and expenses of each business separately. This means that a personal tax return would have two Schedule Cs attached to it, assuming there are two businesses. If it's the same business, for example, lawn cutting services, that's one business. You usually must pay self-employment tax if you had net earnings from self-employment of $400 or more. Under $400, there are no tax implications per the IRS. I mentioned a couple-owned business earlier. As long as the spouse is not paid, it can be children too, this is fine. There is a question in Schedule C input area that asks if a business is jointly owned. It only allows a 50-50 ownership for a couple. It has to be 50% ownership each. There may have more than one Schedule C per taxpayer, and there may be multiple 1099s for one Schedule C if it's the same occupation. If you're a physical trainer and you provide services at multiple gyms or what have you, then that is one business. And if you receive multiple 1099s, you would record them against that one business. No 1099s issued to others, meaning you haven't hired somebody else. No contract labor, obviously, no subcontractors. Statutory employee. Box for statutory employee in box 13 on the W-2 would be checked. Income, again, is reported not just on the W-2, but on Schedule C as well. Regular Schedule C rules apply for expenses. There's no self-employment tax. It's withheld on the W-2 by the employer. Statutory employees, my understanding is they are typically insurance salespeople. Here's a little quiz that I've given you the answers to. Income from recycling conducted regularly. Yes, that would be a business. A clinical trial pay. I go in for a new prescription drug they're checking out. That is not a business. Babysitter. It is a business if it's not a household employee, which I'll define in just a moment. A one-time executor fee? No, unless that is the business you're in. And for a caregiver who's a relative, no, unless you're a relative who owns a caregiving business and who is not a relative. That's yes if you're not a household employee. Now, a household employee, by IRS definition, they include housekeepers, maids, babysitters, gardeners, and others who work in and around your private residence as your employee. Repairmen or women, plumbers, contractors, other business people who provide their services as independent contractors are not your employees. So household workers are your employees if you can control not only the work they do, but how they do it. So business income versus W-2 income. We're going to discuss self-employment income here. So income is not reported on a W-2 for self-employed people, except statutory employees who we just discussed. The taxpayer's business income is added to other income the taxpayer may receive for tax purposes, but something called the self-employment tax is the responsibility of the taxpayer, and this can create big issues. So let me explain. If you receive a W-2, your employer is required to withhold Social Security and Medicare taxes from your income. These are the numbers reported on W-2s in Box 4, Social Security tax withheld, and Box 6, Medicare tax withheld. The way it works is that your employer pays half of the total taxes due for Social Security and Medicare based on your taxable Medicare and Social Security income, and you pay the other half, which is what you see on the W-2. Since the total tax is 15.3%, you pay 7.65%, and the employer pays the remaining 7.65%. Okay, you're self-employed. You pay your half of the Social Security and Medicare taxes, and who pays the other half? Well, you guessed it. It's you, because you're the employer when you're self-employed. So what if you earned $20,000 in self-employment income and didn't account for this? The self-employment tax on your self-employment income, Social Security and Medicare, would be around $3,000. If taxpayers don't plan for this, it can be an unpleasant situation. All's not lost, however, as the government provides some relief for the situation, but we'll discuss that a little later. We'll discuss expenses in just a bit, but I want to add some perspective here. If someone were in a 20% income tax bracket, their top bracket, and their self-employment tax of 15% was added, their effective tax rate would be 35% on every dollar of self-employment income in that 20% bracket. So claiming expense for $100 in this situation would cut their tax by $35. So identifying and claiming all allowed expenses can save the taxpayer, the self-employed taxpayer, quite a bit in potential taxes owed. For purposes of Tax-Aide scope, business really equates to a single person whose income and expenses are reported on Schedule C. All business income should be reported, whether a form received or not. Business expenses are subtracted from or offset against business income. As we're working with individual taxpayers, although a couple can share a business, for the remainder of this discussion, I'll use the term self-employment instead of business. The IRS defines an ordinary expense as something that's common and accepted to a specific trade or business. The IRS defines a necessary expense as anything that is helpful and appropriate, but not indispensable. If business expenses are greater than business income, the result is a business loss. Remember, the business loss is out of scope no matter the amount, even $1. I spoke with a taxpayer last year who delivers newspapers in bulk. Based on mileage expenses for the truck used to deliver the newspapers, the taxpayer had a net loss, which was out of scope. Taxpayer later returned and said the mileage digits had been transposed, which eliminated the loss. Had the taxpayer not been a returning client, I would have most likely turned him away. If the taxpayer and spouse own the business 50-50, enter all the information on a single Schedule C. In TaxSlayer Schedule C, the quote, questions about the operation of your business section, end quote, check the box that indicates this is a qualified joint venture, and TaxSlayer will split the Schedule C between the two spouses and compute the self-employment tax accordingly. I'll show you on the demo where that box is, and so we'll see that in just a little bit. Income may be reported in forms 1099 NEC, non-employee compensation, form 1099 MISC, using box 2 for royalties, box 3 for other income, or box 6 for care providers. Also form 1099K, which is the merchant card and third-party payments. That's Uber drivers would have a 1099K, and by the taxpayer for cash, which has hopefully been documented properly. A business will only use a form 1099 NEC if it's reporting non-employee compensation. It used to be on the MISC, and they broke that apart, created a separate form. If a business needs to report other income, such as rents, royalties, prizes, or awards to third parties, it'll use form 1099 MISC. Generally, a person will now receive the 1099 MISC to report payments that are not subject to self-employment taxes. This is a 1099 NEC. Normally, we'll just see compensation in box 1 and that's it. You typically would not see tax being withheld for federal or state. This is a 1099 MISC. As of 2020, box 7 is used to indicate the payer made direct sales of $5,000 or more of consumer products to a buyer. These products are generally direct sales of a product intended to be resold. There are numerous situations this applies to, but the best illustration of using box 7 is multi-level marketing companies. They generally sell products to their sellers at a wholesale price. You may be familiar with Amway, Mary Kay, Tupperware, Pampered Chef, and others. This is a 1099K. Uber drivers, eBay transactions, Craigslist sales are all by credit card, which are reported on this 1099K. Remember, the taxpayers will probably not be issued a 1099K if their income is less than $600. And remind them that all income is required to be reported. There currently is no input form in TaxSlayer for a 1099K. I'll show you that in just a bit. So the payer may not report correctly. The general rule then is to enter form 1099 MASC or 1099 NEC income in the box needed to get to the right place. If it's a business, use the Form 1099 NEC entry screen for non-employee compensation to get to Schedule C. It's not a business, it's Form 1099 MASC entry screen, things like rents and royalties. This is an image of the federal income area in TaxLayer where self-employment income and other income is reported. Note that there's no 1099K input form in TaxLayer. The 1099K income is entered directly into a Schedule C. So we'll either choose 1099 MASC, choose 1099 NEC, cash, profit or loss from a business would go there, and a 1099, we would select Form 1099K, but there is no input form. Again, just a Schedule C. Here's what a Schedule C input form looks like. The first section, number 1, is general information about the taxpayer's company. So we'll look for basic information and then some specific questions about the operation of the business. Section 2 is where income is reported. Section 3 are the expense categories where expenses are reported. Note the categories that are out of scope. We'll be seeing this in the demo. So we'll be looking at the TaxLayer input forms for Schedule C in just a bit, but I wanted to kind of flow through a little bit with you. At the top of the slide showing Schedule C, where we had numbers 1, 2, and 3, the very top were basic info about the business. And if you had selected that tab, this window would have opened. There's more towards the bottom of this. I've truncated it, but you see at the top it says that this business belongs to, and is it James Daniels or Annette Daniels? Typically, there would be nothing in the business name or employer because the self-employed people, taxpayers, are normally using just their social security number for an ID. They don't have a business number. So this would be at the top. And then towards the bottom of that same input form, it asks for a business type. And there are 6-digit identifiers for specific business types. This one that was selected is for RV recreational. That's the description of the business. So you would click for a list of business codes and go find the code, and it will populate the code itself and the description. This is a requirement for the business. You can see the red asterisk for description of business. It must be included when setting up a Schedule C. Here what business codes look like, just to give you an idea. You go in and it will have categories like arts, entertainment, and recreation. It'll have subcategories of these business codes and the actual codes themselves. You know, gambling industry, 713200, and so forth. When you click on a code, again, the label will go back into the description box. And here are just some examples of codes. You can see Uber driver at the bottom, 485300. After the general business information has been entered, then there are specific questions about the business. You may remember we talked about cash versus accrual accounting methods. This out of scope for us if they don't do cash accounting. Usually these are exactly as they appear. That's what they will be: cash, cost. If an entry needs changing on this screen, it pretty much means it's out of scope. This is what the expense input form in TaxLayer looks like. So at the top you can see advertising. In order to enter a value for advertising, you would click on the box to the right. It would open up another form, input form, and it would ask for a dollar amount and a description. There could be 2 entries for advertising. You might have business cards, let's say, that you're expensing. You'd go in, key in $100 for business cards, save that. Maybe there have signs for advertising, and you would go in, generate another expense for advertising of signs and the dollar amount, save that, and move on. So that's how it's reported. We'll see that in the demo in just so business income that'll be reported in Schedule C, line 1, goes in as gross receipts in the input form. You'll see that on the next slide. Everything should be included there. Anything reported on Form 1099 NEC or 1099 MISC, anything reported from a Form 1099K, and not reported on a tax form, meaning cash or a tip income for self-employed people. So this is the income area in Schedule C. If you clicked on the income box, this would appear. So what it's showing is, number one, at the top, that $2,000 of NEC money, if you will, income, has already been reported. That could have been from one NEC form or multiple NEC forms. That just shows the total at this point. The 13,000 that's circled is the box where those 1099K income numbers would go, plus any cash that the self-employed taxpayer wanted to report. It says the bottom 3 blocks are not used. Actually, the one below the 13,000, you can see it says income reported to you in Form 2 as a statutory employee. We talked about that several times. On the W-2, if it's marked, whatever the wage is goes in here as well. So that box actually would be used. One of my favorites is car and truck expenses. Here's what the input form looks like for car and truck expenses. You put in the description of the vehicle. Usually it'll be a Toyota Corolla or something like that versus Joe's truck. The date you placed it in the service, business miles, commuting miles, and other miles. Those basically other miles are personal miles. So that value in business miles that's required input is just multiplied by 56 cents, and the result is added as a general expense. It's a little busy, but the only thing I want you to come away with from this slide is the fact that you can have multiple 1099 NECs for the same business. I mentioned that earlier. So if you were a personal trainer and you received multiple 1099 NECs, you would need to specify that these, let's say you received 3, were for the same business. And this is how you can do it. Don't memorize this or try to remember it. I just wanted to make you aware that that can be done, and it's done in this way with this screen. We've been talking about Schedule C and input to Schedule C. This is what a Schedule C looks like. If you remember, we had 3 sections on the input. We had the basic business that was at the top, we had income, and then we had expenses. So this is the Schedule C that is the same. We have our basic business. There's the code in box B over there is the business code. There's the name of the business or the type. It's RV recreational. In the middle is the income, the 13,000 that was on a prior slide. And then there's a list of expenses. They would show up here in section 3. Well, my section 3 as I've drawn it on the right. More of a refresher than anything else, business expenses must be ordinary and necessary, not against public policy. So you can't deduct fines or penalties. You can't take speeding tickets. You can't deduct speeding tickets if you're an Uber driver. All allowable and documented expenses must be claimed, and not claiming expense may result in additional tax benefits. Example, to improved earned income credit, which is not allowed. Watch for it. So here are a list of Schedule C expenses, what's in, what's out. We've covered some of these, talked about some of them, but advertising, car and truck, commissions and fees, and so forth. In the red at the bottom, it says tuition related to business, not taken as credit. There are specific credits like the American Opportunity Credit for education. So this is tuition paid for training, education related to the business, the self-employed business. Those other educational opportunities, if you will, are credits, and they'll be discussed elsewhere in another presentation. Out of scope, again, contract labor, depreciation, no home office deduction, and so forth. Which brings us to mileage as an expense. So there are two methods to calculate business mileage. Self-employed taxpayer could either claim actual expenses, that's out of scope. So forget anything else except the standard mileage rate method. The standard mileage rate method says that for every mile that is legitimately allowed, a self-employed taxpayer can claim 56 cents. And we'll show what that covers. So taxpayers using actual method, we should refer them to professional preparers. Publication 463, I just put up a little snippet of the top of what it looks like. That's for travel, gift, and car expenses. If you have any issues, details you'd like to see, it's in that, or they are in that publication. What's in? Here's the standard mileage method. The standard mileage rate, that's 56 cents per mile, includes depreciation or lease payments, gasoline, oil, it's all covered, repairs and maintenance, regular car insurance, car registration, the part that's non-tax, and car washes. Car washes was apparently was some contentious thing a while back. It was in, it was out. The IRS came out about 2 years ago or so and said car washes are included in the basic mileage rate. You can't claim them separately. So do not include these items as additional expenses on Schedule C. The standard mileage rate does not include things like parking, tolls, car registration, the property tax portion, interest in a car loan. We're only talking business portion only. You had a car, if you drive a car, you have a loan on that car, and you use it 50% of the time for business and 50% of the time for personal, you can only use the business portion of that to claim as an expense. Include these items as additional expenses on Schedule C. We're still on mileage. I want to talk about commuting versus deductible transportation miles. So, first and last trip of the day, those are non-deductible commuting miles. Meaning if you were a self-employed taxpayer and you went from your home to an office, from your home to the office and back again are considered normal commuting miles. You cannot claim those. Business hours between the first and last trip are deductible. So if you go to your office and then from that office you go elsewhere and return and then go home, the miles that you did out there in the world were all deductible. Uber driver, will use them as an example. Their first trip leaving their home going to wherever they go is commuting. All they do during the day or evening, all those other miles they're driving around are deductible. When they finish their last ride and head home, that is considered commuting and that is not deductible. So first and last trip of the day, deductible mileage with home office deduction. Well, that's out of scope. You can't have a home office and deduct it as an expense in Tax-Aide. Refer to taxpayer's professional preparer to claim the home office deduction and increased mileage. Again, taxpayer will determine the business miles. We're not there to say, we think you had this many. They will tell us based on overall mileage, commuting, and so forth, how many miles they are claiming. Mileage. Here's a picture that depicts which miles are deductible for expenses and which are not. So I'm going to try to draw here and show you. Here's my home. And I start off in my home and I go to an office every day. And I return from that office every day to home. Those are considered normal commuting miles. I receive nothing for those. I cannot expense any of those miles. Now I go to my office, and from my office, I go to another location and return to my office. Those miles are totally deductible. If I go from my office to a second job and return, those are deductible. Those are an expense. If I go from my second job to a temporary location or back the other way, those are an expense. If I go from home to a second job and return home, those are never deductible. It's the same as commuting to my original job, my regular job. The situation up here from 9 o'clock to 12 o'clock on this diagram, the situation up here is I live in Plymouth, and let's say I commute to Scituate every day, and I go back and forth. Those are commuting miles. But my company says, you know, next week we want you for 3 days to go to Providence, Rhode Island. So instead of going to the office, I go to a temporary work location in Providence and return home. Those are and can be expensed as mileage. That's it. So it's all this, did I go to office? Did I go to a temporary location? This diagram explains it. It becomes easy after a while to understand. I mentioned first for Uber drivers, Lyft drivers, and so forth, first trip of the day from home to pick up, first pickup, and last trip back to home, those are commuting mileage. That's not deductible. On-trip mileage, everything's deductible. Uber actually tracks it, and it'll be listed on the supporting document from Uber. The number of miles they drive during the year normally is listed on they get a yearly statement, equivalent, well, the 1099K. And on there, it actually will tell them how many miles they travel during the year. But that shows them total miles, I believe. Between trip mileage, deductible. May now be tracked by Uber. If not, it's provided by the taxpayer. Added to the on-trip mileage for total business mileage. So for hire drivers, Uber and Lyft, they have other deductible expenses. This is besides their mileage expense. Cellular service, the business portion. If they have a cell phone, they have to say, I use my cell phone 10% of the time for my business, and the other would 90%, and then they would just prorate the amount they paid for service. A dash cam, they can expense a dash cam. There's a number of fees, beverages and snacks, water for the passengers, ride-sharing insurance, toll transporter, interior cleaning, and so on. Even like seat cushions for their automobile are deductible. So Nancy's a self-employed hairstylist. She works 5 days a week at a salon, which is 6 miles from her home. On Wednesdays, she leaves the salon at noon and drives to the local nursing home, 4 miles from the salon, and provides service for residents, and then returns to her home, 5 miles. How many miles per week could she deduct? Well, she can't take that mileage because she works 5 days a week. She goes to the office and she returns from the office. On Wednesday, she leaves the salon at noon. She drives 4 miles from the salon and provides a service. She can deduct those miles. And then she returns home. Well, the return home is considered her commute, her return commute for the day. So the number of miles that she could deduct is actually, wow, that's awful, 4. So expenses an outside office. Rent is an expense that's allowable if filing Form 1099 for payment is not required. Office expenses, postage, supplies, all of that, that's an expense. Those are allowable expenses. Insurance, taxes, business telephone, and utilities. Uh, Again, all of that allowed expenses. Home office deduction, no. We don't allow home office. It's out of scope for us. Tools or equipment expected to last more than 1 year but costing less than $2,500 or invoice can be deducted as a business expense. List them on Schedule C as other expense and describe as de minimis election under regs and amount being expense. That's what would go into the description in the other expense input area. I'm going to move a little quicker through these because these are just expenses, and over time you'll learn them. You'll be able to research and look into the documentation to determine whether these are in or out, 4012 and so forth. Education costs, tuition and fees, course-related books, supplies, and equipment. Remember, they claim this. They're not claiming this as credits, the other educational credits that they could get. Parking and transportation to and from school, travel expenses must be needed to maintain or improve skills for the present business they have. Does not have to be a qualifying educational institution. I don't know what that means. I'll be establishing my own educational institute next week for anyone who wants to sign up. Computer costing more than $2,500, that's out of scope. Only the business use percentage of a computer can be deducted. If it's used, if they expense, let's say, a $2,000 computer, and they use that computer 10% of the time for business, then $200 could be deducted as an expense. Taxpayer needs to keep records of that, and we already talked about paper. Well, paper, toner, office general supplies, that can be those can be claimed. Telephone expenses. So business telephone, if it's dedicated phone used only for the business, it's 100% deductible. Mixed use landline phone. So the basic landline service to someone's home, let's say, is not deductible. But the cost of any calls required for the business, long distance calls, toll calls, they are deductible. Now, a mixed use cell phone, we kind of talked about that already. They would prorate the cost based on the business use. What percent of the time is it used for business versus personal use? Meals, which reminds me I haven't eaten yet, 100% cost of meal is deductible. By the way, this applies to 2021 and now 2022 till the end of the year. Cost of meal is deductible, must be from a restaurant. That includes takeout restaurants. If it's not packaged takeaway meals, like things you get at a mini mart or a grocery store, it's 50% of such meal cost continue to be deductible. Now, Steve can't go to the restaurant down the street and have Steve a meal and claim that as a meal. It has to be a business purpose. There must be at least one other person there with me, and I need to track it, say why we were there, how much, and so forth. Special documentation rules apply if a business meal is over $75. Entertainment expenses are not deductible, and taxpayer needs to keep records. So here's a quiz. Quiz is, which of these items are deductible for a bookkeeper? So a bookkeeper, postage, okay. An employee pension plan, not okay. Fairfax County, where I used to live, business license. Yeah, if I require it from my business, then it is deductible expense. Primary use cell phone. Yeah, partly. If it's if I primary, whatever percentage I use it, I can claim it. Table saw. Why does a bookkeeper need a table saw? Business cards? Yep, those are advertising. A small printer? Yep. College course to improve job skills? Yes. Payments made to a subcontractor? No. And so those are the answers. So this is a pretty meaty slide. Uh, Net profit is used to calculate some pretty um, nice deductions that potentially self-employed taxpayers can receive. So the self-employed insurance deduction, health insurance deduction, allows independent contractors and other self-employed individuals to deduct health care premiums they pay up to 100%. To take the deduction, they have to meet certain criteria. Qualifying health insurance includes medical insurance, long-term qualifying long-term care coverage, and all Medicare premiums. So premiums paid can be for the taxpayer, for the spouse, and any non-dependent child who's under 27 at the end of the tax year. For any taxpayers who are itemizing deductions, they should test to see if claiming the health care, the health insurance on Schedule A yields a better result. So if it's better for them to use this to itemize, they make more of a, it's better tax-wise, they should do that. If there's an excess left over, it will automatically be moved to Schedule A. So if they can use this for let's say a $2,000 expense, and they had a $3,000 in premiums for healthcare and so forth, then that's $1,000 left over. That can be used and is automatically moved over to Schedule A to see if that helps them with their itemized items. Qualified business income, QBI deduction. A sole proprietor that reports profit on Schedule C will be able to take up to 20% of qualified business income as a deduction on their tax return. So TaxSlayer will compute the allowable QBI. We don't have to do that. It's based on the income and expenses entered into the return. Now, there are some exceptions based on total income, and meaning there's a limit to how much you can earn and still qualify, and for certain services and businesses. Publication 4012, tab F, contains the details. So self-employment taxes, Social Security, Medicare. I mentioned earlier, it's pretty onerous when people who are self-employed find out that they're going to owe the full self-employment tax of 15.3% for Social Security and Medicare. If the employee were working for a company receiving the W-2, they only pay half. And a statutory employee, although is self-employed, the statutory employee receives a W-2 and only pays half. So that can be quite a deduction. The family leave I've kind of graded out here was something that was a credit for 2021. I'm only mentioning this in case you're a returning tax counselor and may need to generate a 2021 return. New counselors, I bring this up for another reason. If you're a new counselor, you're only allowed to work on tax returns for the years in which you are certified. Qualified business income deduction. Again, it's taken from profits from the business. Once profits are realized, 20%, up to 20%. If there are more than one business that a taxpayer owns or is, then the QBI deduction is calculated for each and totaled up to give the result. This deduction is a below-the-line deduction, the term below the line. What it means is that it reduces taxable income, but it doesn't reduce the adjusted gross income. And so it's not a deduction, if you will, that's taken before adjusted gross income is determined. So all is not really doom and gloom when it comes to paying the self-employment tax. Self-employed taxpayers can deduct half of their self-employment tax from their net income when calculating their income tax. And well, that would really be, again, the employer portion of the self-employment tax. So as an example, a taxpayer, normally they're supposed to pay during the year for Medicare and Social Security. Well, let's say they owe $2,000 in the self-employment tax for the year, and they pay that money when it's due. But at tax time, $1,000 would be deductible on their Form 1040 due to the self-employment tax deduction. And since I mentioned paying taxes during the year, I just wanted to show you what the screen looks like. You can forget about this for a while, but this is where estimated tax payments would be reported. If they made federal estimated tax payments during the year, they would put them in here, and they then would be deducted from overall tax requirements. Two quick slides on self-employed health insurance, and then we're done, I promise you, with the presentation. Qualifying insurance, as I mentioned earlier, includes Medicare. It can be paid by the taxpayer or the spouse. But don't double count Medicare if itemizing. So they can use, if it's $2,000 that they could claim as a self-employed health insurance, and they do, and then they claim $2,000 for itemized deduction or against that, they can't do that. Other health coverage, if not subsidized, so they can include dental premiums, vision, and so forth, includes long-term care insurance. It's limited to something called the age-based deduction cap. This applies to insurance only. It does not include other medical expenses. This is the last slide, I promise. Health insurance deduction. It's not allowed when the taxpayer is eligible to enroll in the spouse's employer's plan, even if the taxpayer chooses not to. Maybe because it's more expensive than the taxpayer's own plan. So the bottom line on this is, my wife works for an employer. They offer health insurance. I am self-employed. We choose not to use the health insurance offered by her employer. My health insurance deduction would not be allowed. Second bullet on that slide, the taxpayer can take the deduction for any months the spouse is not offered. If she were working for an employer and halfway through the year they didn't have it, and halfway through the year it became available, then for those months when it wasn't available, I could take the self-employed health insurance deduction. That's it. Okay, last slide except the questions and comments slide. So any questions or comments?